Hello, my name is Laura Claypool, and I'm going to be with you for today's training on a guide to sensitivity analysis in capital budgeting. Before we get into the details, let's start with that big picture, why we're here. In financial management, our main goal is simple: to make the company more valuable for owners. We do this through three main jobs. The first, capital budgeting. It's about deciding which major long-term projects are worth investing in, and that's our focus today. The others, capital structure and working capital management, are deciding how to pay for those projects and managing cash. As we get into this, remember that risk is a natural part of these decisions. As the risk management expert Philippe Lemos states, to avoid risk is to forego opportunity. So our job isn't to eliminate risk, but it is to manage it smartly. So what is capital budgeting? In simple terms, it's how we decide to spend big money on big projects. The problem is our decision relies on forecasts, and forecasts are just best guesses. This reminds me of a risk management technique I learned in undergrad for outdoor rec. When faced with uncertain situations, our professor would ask us to ask ourselves, what would Nick the Greek do? Nick the Greek was our stand-in for the wild card, that one unpredictable factor that could really change everything in our situation. Nick the Greek was an ultimate high-stakes gambler, professional poker player, cultural icon. He passed away in 1966. It was estimated that he won and lost more than $500 million in his lifetime. Capital budgeting is a hard look we must take to evaluate potential major projects or investments. As described by Kenton, building a new plant or taking a significant stake in an outside venture are examples of initiatives that typically require detailed financial evaluation through capital budgeting before they are approved or rejected by management. In finance, that what if question and the sensitivity analysis is our corporate version of that. The sensitivity analysis is the what if game we play to see how sensitive our project's success is to a change in one of our key guesses. By asking, what would Nick the Greek do in our plan? We're training ourselves to look for the unpredictable or that worst case reaction. It forces us to identify the most volatile variable and build safe options to ensure that if a wild card appears, the business doesn't topple. So how do we run the numbers in that what if? First, we create our base case, NPV, using our most likely guesses. Second, we identify the variables where we're most unsure about, like sales or cost. And third, we change only one of those variables at a time to see what happens. So if we're going to test for negative 10% of sales, we only do that one. To show you how powerful this is, I found a fantastic case study from 1967. It's an article by William House in the Management Services magazine. He analyzed an oil company project and found that a 10% error in the sales price forecast would cause the project's return to plummet by more than 60%. But a 10% error in forecasting the initial investment cost only caused a 7% dip. And this perfectly illustrates the goal here. Sensitivity analysis tells you exactly which variable is your biggest risk. In this case, it was sales price. And the coolest part, in my opinion, is that even though this study was from decades ago, the core lesson is timeless. Tools have changed. Fundamental logic of finding and managing our biggest risk factor remains a cornerstone in our smart financial decisions. All right, but team, the risk is not just about the numbers. Okay, it's not just about that spreadsheet. A truly robust sensitivity analysis has to look for qualitative factors, the risks we can't easily manage. And this is where we run into the human element of business. This brings me back to that legendary high stakes Nick the Greek. He spent his life calculating card odds, but he famously observed that the house doesn't beat the player, it just gives him the opportunity to beat himself. In corporate capital budgeting, the house is the external market. The market doesn't usually destroy our projects on its own. Instead, we kind of beat ourselves when we let emotional biases, over-optimistic sales forecasts, or refusal to look at the worst-case scenarios blind us. As the risk literature reminds us, risk is heavily shaped by the individual perceptions and subjective beliefs rather than pure mathematical certainty. If we don't actively stress test our qualitative assumptions, we're simply giving ourselves the opportunity to fail. Once our sensitivity analysis tells us the project is volatile, we've looked at the risk. What do? We need to formally account for that risk in our decision. The most common internal method is known as the risk adjusted discount rate. The logic is simple. If a project is risky, we demand a higher return from it, which we do by using a higher discount rate. And this isn't just textbook theory, it is exactly what companies do in the real world every day. For example, in a recent honors thesis, the author interviewed an employee at a large company who explained that for their big investment decisions, they take their standard discount rate and specifically, quote, add a cushion to account for risk. They also limit their forecast to just 5 years because of, quote, future uncertainty. This is a perfect practical example of the RADR method in action. It's a clear, simple way to build the margin of safety directly into the financial model. And besides adjusting things internally, we can also look to the financial markets to tell us how to price risk, looking outside. The main tool for this is the Capital Asset Pricing Model, or CAPM. As Dahlquist and Knight explain, the CAPM is a formula that calculates the return we should expect based on a project's risk. It starts with the risk-free rate, like what a government bond pays, and then it adds the risk premium. That premium is based on the project's beta, which is the number that measures how risky the project is compared to the stock market. It's in a powerful, data-driven way to find the right discount for our project. And to wrap things up for you guys today, let's look at the core lessons. Capital budgeting is how we grow our company's value, and the sensitivity analysis is how our primary shield against an uncertain future, our risk assessment. As we go back on our daily roles, I want you to keep Nick the Greek's famous quote in mind: the house doesn't beat the player, it just gives him the opportunity to beat himself. In the business world, the house represents that external economic variable we cannot control. Interest rates, market competition, supply shocks. We can't control those. But what we can control is our own analysis. If we fail to stress test our numbers, if we ignore qualitative signs, if we refuse to adjust our discount rate for risk, we're beating ourselves. By using sensitivity analysis and combining internal and external risk methods, we can take control of our decision-making, ensuring we say yes to the right projects and build a resilient, wealth-maximizing organization. Here's some references for today's training. I really appreciate your time and attention. Thank you.